Real wealth is built by holding real estate long term, not by holding real estate for like 18 months, which is what we're seeing a lot more of these days.
Welcome to the Multifamily Wealth Podcast. I'm your host, Axel Ragnarson, and on this show, I dissect how seasoned multifamily investors started, built, and scaled their businesses. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. This week, I'm chatting with one of the most well-known guys in the multifamily game, Matt Faircloth, who is the founder of the DeRosa Group alongside his wife, Liz. And Matt is one of the most well-known multifamily investors, thought leaders, content creators, YouTubers, etc., authors I should throw in there as well. And the reason Matt is so well-known is he's one of like the OG guys from Bigger Pockets. So he started writing blog posts on there and contributing on the forums way back in like 2014, I believe, right when Bigger Pockets was really starting to gain some momentum in the real estate investing community, and became a really well-known writer on the blog side of the website, and then also ended up writing a book that was published through Bigger Pockets Publishing that really entirely talks about raising capital and how investors can raise private capital for real estate, whether it's equity, whether it's debt, what have you. And Matt's got a great story on the real estate side as well in terms of like the business that he's grown and that he's operated alongside his wife. And, over the last 10 years, they've bought thousands of units of multifamily assets, large assets, everything from 300 plus unit Class A properties in North Carolina to, 20, 30, 40 unit properties in New Jersey, and has structured deals in all kinds of different ways, whether it's syndications, whether they're smaller JVs. They also have a really unique approach to just property management and landlording in general, called incentive-based landlording, that we talk about at the end of the show. And Matt's just a great conversation too. He's just a really upbeat, energetic guy. So I think a lot of folks are going to get some great things out of this episode. And we specifically talk about how you can start raising capital if you're newer to that side of the business, and if you haven't already started raising money, how you can start telling your story to investors and start cultivating relationships with investors. We talk about JV, joint venture deals versus syndication deals, and which deals make sense for which structure, and how you can actually think about doing JV deals while still being compliant. How you can start thinking about syndicating deals. And all in all, this was a great casual episode. We also spent some time talking about how the traditional syndication model is oftentimes oftentimes does not align incentives between GPs and LPs. And Matt shares some ideas on how that could be fixed with potential deal structure and just in terms of the relationship between general partners and limited partners. So a lot of great stuff in here. Highly recommend you listen to this one all the way through. And if you do enjoy it, please leave the show a rating and review. Helps the show get noticed by more folks. And that's obviously my goal as the host here, is to get this message in front of more people. But again, thank you for listening, and I will catch you guys on the next episode. What's going on, everybody? Welcome back to another episode here on the Multifamily Wealth Podcast. Joining me this week is an incredibly accomplished investor. He's an author. He's a YouTuber. He's all over the place. We got Matt Faircloth joining us this week. And I'm pumped to have him because I was maybe one of the first customers when he released his first book with Bigger Pockets about raising private money. So haven't had the chance to speak with him. I'm speaking with him now, obviously. But Matt, it's a pleasure to have you on the show.
Axel, it's an honor to be here. Thank you for having me.
Absolutely. Well, why don't we start with your story? We'll go back as far as you'd like to go. Maybe talk about what you were doing before real estate and how you got into the business and maybe what your business looks like now.
Yeah, man, no problem. So I went to college at Virginia Tech. I got my degree in engineering because people told me I was good at math and science. And so you should become an engineer because that's what people that are good at math and science do. Side note, Axel, I probably know 3 or 4 dozen recovering engineer, now real estate investors. I don't know why it is that there's so many engineers in the real estate world, but there are. Anyway, so I got my degree there. And about halfway through college, I realized, man, I don't want to be an engineer, but like, I don't want to be like, I was just too people oriented to be like on a desk, crushing out numbers and, working on processes and stuff like that. And I don't disrespect that. I don't. It's just something that didn't really call to me. And so I was lucky enough to find a job in sales that required an engineering degree. So I got a job in sales and I sold technical equipment, like really, really large machines for a company that you might be familiar with called Ingersoll Rand. They're like a big equipment. They make stuff.
It seems familiar. Yeah. I feel like I've seen that logo in the company name. Yeah.
Next time you're stuck in traffic on the highway, Axel, just look on the side of the road, and the construction job that you are stuck in traffic because of is likely brought to you by equipment from Ingersoll Rand. You'll see their stuff all over the side of the road. And I sold their stuff that went into factories, which was a cool job because you got to see how stuff I was in factories every day. I got to see how stuff got made. It was actually really cool. But there was a glass ceiling, as any job has, and I was happy doing it. I made a good living, as most jobs give you, a good enough living to get by, good enough living to keep you happy enough, right? But I started dating a young lady that I then married, my wife Liz, who I've been married to for 18 years now. While we were dating, she was finishing up at UPenn, and she put Rich Dad Poor Dad in my hand because her brother-in-law had put it in her hand and got her to drink the Kool-Aid. And funny enough, she was getting her master's in social work from UPenn, and she had the same epiphany that I did back when I was in college, that, okay, this is awesome. I love people and I want to do this, but I also don't want to do this. I want to do what the technology of Rich Dad Poor Dad teaches about building businesses that are centered around assets and things like that, because you can just go further and there's no ceiling there, right? So her and I, while we were dating, started buying real estate together while we were dating, and started doing deals and got into the real estate business. And we became so hooked on it that when we got married, I quit my job at Ingersoll Rand to start our company, the DeRosa Group.
That's incredible. Now, so give us some, you mentioned you guys met, or you've been married for 18 years, it sounds like.
Yep.
So when did you start buying real estate? You mentioned you were buying real estate as you were dating. Was this, was this like shortly after graduating college? You mentioned you were obviously working at the time, but was that, I'm trying to define when that was,
I get it.
I want to talk about the market environment at the time. Yeah.
I am older than that. No, I worked for Ingersoll Rand for 7 years
Gotcha.
before I quit my job. So that was in 2005 that I quit my job. And so you think about, we can rewind back to the market then. Now, we were not investing in multifamily. We were in single family homes. We were in fix and flips. We were doing wholesales. We were doing, I like to say the word entry level because it's just what it was. We were just doing smaller price tag real estate deals that were more accessible to us at the time, and accessible to our dollars, and accessible to our confidence level at that level for getting into real estate. So first real estate deal that we did when we were dating was a duplex. This is way back, Axel, where you could buy, let's see, I bought a duplex back then on no money down financing with a first mortgage and this wacky thing called a second mortgage, which you can rarely get anymore. You can't get those anymore but back in the day, I got an 80% first and a 20% second. So you had to walk into closing with nothing but a smile. I mean, that was it. I mean, maybe enough for closing costs, but if you're smart, you could negotiate your seller to pay your closing costs for you. So you literally walk in with a pen, with a pen and a smile, no check. So that was the real estate market. Then it was a beautiful time, and it was funny, actually, everybody back then knew that party could not continue. I remember specifically talking to people in 2005, 6, and even the beginning parts of 2007 about when the crash was going to happen. People were like, this has to stop. We all don't know when it's going to stop, but at some point, this party cannot continue. I had buddies that were refinancing properties every 3 months and pulling 5 digits out of the properties every time they refied. I had buddies that were buying real estate that was in the red, in the negative cash flow properties, bought it for appreciation. Literally, we're buying deals that were losing $3 to $4 a month, but the deal was going up 10, 15 grand a month. So they were in the black technically. Right. Mm-hmm. So that was the party that was going on then. And rightfully so, the party stopped, and we were around for that when what hit the fan. So.
Yeah. And that's what I wanted to jump into was, to kind of frame because I think when you got into real estate, it's similar to a lot of the people that listen to this show and just what the real estate market is now, where it's a lot of people that got into the business in 2019, 2020.
Yeah.
I'm not going to sit here and pretend I know what's coming in the next 12 months. I don't think anybody really does. I think we can all make a safe assumption that pricing's got to adjust a little bit to the interest rate environment. And that's a reasonable assumption to make, right? Will it be as bad as 2008 and 2010? I mean, I don't know, probably not. But again, we're not here trying to make those bold claims. But I think that the fact that you got into the business at a time where it was really humming is similar to a lot of the folks that are listening to the show and that are in real estate right now. So the first question I want to ask you, because I want to dive into that a little bit more, is when did you get into multifamily? Was that post crash? Was that, did you kind of make the pivot at some point or for a specific reason? And then I would like to talk about maybe what what you saw in the marketplace after the crash and how you guys adjusted to that in your business.
Lots of blood. No. Lots of blood in the streets. Okay, let's start with how we got into multifamily. We've always been involved in residential housing because that's just what we got into at first, is what made sense. It's what was the least complex for a recovering engineer and a recovering social worker getting into the game that had very little real estate training. I went out and got my real estate license, but that was about it, right? So we've always been in residential housing, and we slowly grew in portfolio size and in deal complexity. So multifamily, after the duplex that we bought when we were dating, we got married, and then a year or so later, we bought a couple of 4-family homes, quadruplexes, right? So we bought them in a string of them in a row on one block, right? So I guess you'd call that multifamily, because that ended up being 12 units, and then we added a few more to it over time to get it up to 20. Just bought more down the block, if you know what I'm saying.
Oh yeah.
Our first single purchase double-digit deal was a 10 unit that we bought in Jersey, and then we slowly started to scale from there. But what allowed us to do that, what allowed us to get into larger and larger multifamily deals, which again, we've always been a residential housing provider. And so it made sense to get into bigger and bigger multi. We just, as we scaled up, realized how much easier multifamily was. But what allowed us to do it was private capital. And I talk about it a bit in my book about, people that have money, but no place to go with it. More and more of them started to come to us in 2010, 2011, when Liz and I had about 30 units of our own. And some people that she knew from Penn, and some people that I knew from college, and some, just people who knew from our network started to come to us and say, "Hey, we see what you're doing. We want to do that too, but we just don't have the time. So can you invest our money for us?" And we were like, "Yes, let's show you how to do it." So we got a lawyer that showed us how to assemble, he didn't call it a syndication. It was I just bring in joint venture partners and an LLC. This is how it goes. And so our partners were active at the time. So it was just a JV. So it wasn't like a 100% passive LP GP relationship like you see in syndications. These were people that were putting in $50K into our deals. Like one person would be our investor at $50K, $100K, that kind of thing. That was how we got started. And we would just go up and buy 2 or 3 single family homes. That scaled up, and we started getting to more and more complex. And then we got, 4 or 5 investors to put up $50K, and we would go and buy, 3 or 4 small multifamilies for 300 grand. We'd go and do a couple of deals. And it just scaled and scaled from there. And our big, big pivot, Axel, was when we bought a 49 unit out in Lancaster, Pennsylvania. I raised $1 million as a fully registered syndication. People put anywhere from $50K up to a couple of $100K, and we were able to apply that. And that vehicle that we assembled then was pretty much the model we still use today for our business. And then that was 7 or 8 years ago.
Yeah, absolutely. No, and that's great. I mean, it seems like, I relate to that story a lot because I had a very similar path. And I think a lot of the people listening have had the same or similar path where take down the duplex, take down a couple of 4 units, maybe you take down a 6 or an 8, and then, you start to organically grow the portfolio. You're at 20, 30, 40 units and you're sitting pretty, but you kind of hit a wall after that in terms of maybe you run out of money, or you're just not excited about doing that same size of deal anymore. So you want to go and do bigger deals. And then you got to put the puzzle pieces together and figure it out. In terms of those early deals that you were doing, right, where you did some joint ventures, and this is something that I know a lot of the people listening would find value in. You have some friends, you got some family, some colleagues or people in around you that got 50K, they got 100K, and maybe you got access to the 300 grand, the 400 or 500 grand, whatever it is, right? And you're putting together some pretty simple deals, some JV deals. Can you dive a little bit more into maybe the structure that you were using at the time, or just a structure that you'd recommend? I don't know if those answers would be different. But for folks that are maybe looking to do, they got 3-4 people that want to write them a check and they're just trying to figure out how to get their feet wet in this world.
Yeah. You can do the best way to do it on the super small stuff like that is to do like a joint venture, right? Where it's not a SEC registered syndication or anything like that. And the reason it's not is because your investors aren't 100% passive. To make an investor not 100% passive, all you got to do is give them something to do. Give them a job, right? When I first got started, my investor was keeping the books. And it made him feel really good because it was, he was this, the money into the game. So why would he not want to take a few minutes it was 2 single family homes, right? So you're not talking about like a super long spreadsheet or hours and hours of his time. He did that. And he also was a personal guarantor on the loan. So those 2 things, being a personal guarantor from an investor pretty much makes them active because they don't maintain their financials. They're at risk. They're very it's very not a passive position for anybody to be a personal guarantor. So those are 2 ways that you can keep your investors involved. But to bottom line it, if your investors have a active role in the project in some form or fashion, and that could be driving by there and shooting a picture, doing a walkthrough every here and again, documenting the work that they're doing in the operating agreement and documenting the work that they're supposed to do in some other form or fashion, they're active. And anytime anybody is making money through their own efforts and through your efforts too, then they are an active investor, and that qualifies that as a joint venture versus just selling equity through a syndication. Can you do that for like 30, 40 investors? I wouldn't try it. That'd be an easy way to me, I think the SEC would not look happily upon that. And actually, I didn't do that on anything more than like 3 investors. Like anything more than that, we understood like, listen, these folks kind of do have day jobs and it's just there's not that many jobs to give around, for people to do, right? And investors only want to do but so much because they get that I'm the sweat equity. So they want me to do most of the work anyway. So we kind of got away from that model after when the deals got over like, 300K in equity, we discarded the JV model altogether and just started doing a straight like syndication, which isn't the end of the world. People think that's a bad word. Like, it's syndication. It's going to be expensive. It's going to be complicated. It's actually not that bad. It's really not,
Yeah, exactly. And I think, first of all, that was a great distinction, right? And that's the critical distinction that you need to make when you're putting a deal like this together is, am I going to do, are all of these people materially involved in the success of this deal? And it makes it a lot easier to structure a deal like that. If you have a few investors writing bigger checks, and bigger is relative, right? Let's call it 100 grand versus 3 folks at 25. Because then it's not, if you have 5 people at 25, that's not, it's not really worth all of this to do all of this stuff, right? To make sure that you're compliant in all these different ways versus you get 3 people at 100 to 200 a piece. Well, that's fine. Now you got to, it's a little bit easier to give them a job and to actually, raise some money from a smaller select group of people.
Maybe they want to be in on it. Maybe at the end of the day, they're like, if they're putting that kind of money at work, and then you don't have like a, 5-10 year long track record or something like that, maybe it makes them feel a little bit better to be involved.
Yeah, no, 100%. And from like an actual tactical structure standpoint, from like a return standpoint, would you structure the deal the same way, like some kind of split with a preferred return, or did you keep a more simple deal structure when you were doing JVs versus doing syndications?
We used to not do preferred returns at all, Axel, and I miss those days because I preferred return. I'm not a fan. We have a lot of deals that have preferred returns, but I've been thinking a lot about it and a lot about how syndications are structured. And if you look at the origin of preferred return, it was actually put into deals by those that were doing developments, like those that are doing buildings and stuff like that. It got injected into multifamily as a derivative of things that were not multifamily, So we do offer them. I'm not the biggest fan because I don't think it's a win-win personally.
Mm-hmm.
And I think it actually forces the syndicator likely to sell sooner than they really ought to, because that's the only way the syndicator makes any money, because the deals just pretty much the deals just their service in the pref for the foreseeable future. And it's just the syndicator likely doesn't win. And the investors really don't win either. All they're getting is their straight pref. Is this even there's supposed to be upside, the upside side of it doesn't kick in too much until you either do a smack out of the park refinance or you sell the property. Mm-hmm. So that's my 2 cents. But we up until our deals are numbered, right? So we have DeRosa Capital insert number. And so up through DeRosa Capital 7, we didn't do a pref. And investors made plenty of money. Everybody got cash flow distributions based on how much we made. It was just a straight, you get this percent, we get that percent. DeRosa Capital 8 through 16 all had a pref assigned to them. So we've done both, and I've got thoughts on both. We've done waterfall structures. We've done, a couple different ways that you can carve up the pie depending on the deal.
No, and yeah, I agree with you. I think the challenges with preferred returns is that a deal rarely produces enough, just cash on cash return to actually distribute anything to the general partners until you get to a point to where you do that big cash out refi and you pay down a big balance of your investors' capital accounts. And now you're starting to see some money on an ongoing basis. But until then, you're either just paying it or you're even falling behind and it's accruing over time. And it's, it's one of those things, and we've fallen victim to them in our business where we put a deal together or many deals with preferred returns, and then we just elect to sell instead of refi because it's makes a little bit more sense for us as owners to cash in on the value we've created. And oftentimes,
and by the way, actually, then you have people that are doing deals. If the GP is not making any cash flow at all because of that pref, if all the lion's share of all the cash is going to the LPs during the ownership cycle, then what do you got? You got a GP that's doing it, and you and I care, right? So we're going to keep operating the deal and doing it for the AM fee that we get and all that kind of stuff, right? And then eventually you get paid, and I've got enough deals going on that it's fine. But for a rising syndicator, what you end up having is people that maybe are doing deals just to get that acquisition fee, right? Yeah. And that is a flipped upside model. No investor should get excited about that, because at the end of the day, then it's there's a carrot that the GP gets, but the stick that is holding that carrot out there is so long that the only way that the GP can really, make a living is do lots of deals that have an AQ fee and then walk away. No, but not, we're not doing that. Or to, hold their breath and wait for that deal to refinance or sell or whatever it may be, to the point where they get to eat. And so I don't think it's a win-win model. Again, we have a good amount of deal flow and that, so we're not subject to that, but I do think a lot about rising syndicators, and how it's just, I'm hoping that the market shifts away from expecting a pref plus a huge chunk of equity going into the deal and more of a win-win, which I believe the win-win model that should exist is what we're gravitating towards this. Here's the new model that I think, if you're a rising syndicator and you're listening to this show, here's the model that I think you ought to be doing. Give investors a pref under one share. Let's call that Class A shares, right? Class A share is just a straight return to capital, return on your money. So it's just a pref equity share. Let's call it what do you want? 6, 7, 8%, whatever the deal can afford. And you only sell but so many of those shares. That's not all your equity stack. That's maybe 10 to 15% of your equity stack. That just is a cash flow share. As soon as the deal closes, those shares go out. We have those shares and we pay them out monthly, right? And that yields anywhere between 7 to 9%, depending on the deal. Then beyond that, you've got your equity shares, and those should be just straight equity, whatever split you want to do, 80-20 split, 70-30 split, whatever the deal can afford to get investors a juicy rate of return that they're excited about. And then the GP gets a cut of the profit of the deal from Jump Street. From the beginning, they get their 20-30% after the Class A shares get sold. Those Class B shares, get a cut of profit, and so does the GP. And it actually enables the GP to be incentivized to hold the deal for longer. They don't want to sell. They want to enjoy upside potential. They want to pay down the debt on the property and hold it as you should. We should be hot potatoing multifamily these days. We should be like holding these things long term. Real wealth is built by holding real estate long term, not by holding real estate for like 18 months, which is what we're seeing a lot more of these days.
No, and I
I'll
think
step down off my soapbox now.
No. Because I completely agree. And, it's funny. It seems like, I've only been in the business since 2015, right? Really only seriously been in it since 2018 or so. So for about 5 years in terms of raising money, like doing a higher volume of deals. And I feel like I've seen a change, even just in the time I've been in it, where we go from this pref structure to the dual class structure where we have some kind of a class A and a class B. And then the last couple of years, it was just, let's do a ton of bridge with a crap load of preferred equity, and 5% of the equity is common equity. And now we're swinging back the other way, where it's, a lot of fixed interest rate debt with multiple classes of shares with tiered waterfalls. And it's like the market's trying to find what works. And what's a little bit frustrating is that oftentimes I shouldn't say the loser, but who ends up just taking the brunt of all of this is the uneducated limited partner who doesn't really know what the right deal structure is and doesn't really know how to evaluate all of these structures against each other, where you have a ton of pref equity in one, and then you have 3 classes of shares in this one, and then you have different classes depending on how big of a check you write, but they're all treated the same. And it's interesting, right? So I would imagine that over time we start to, maybe arrive at something that is a little bit more industry standard, if that's even a word that I can use here. But I like what you just mentioned. I think that does align incentives pretty effectively from the get, which is, let's buy this property, let's hold it for 5-10 years, whatever it is, instead of just ramming a value add program down everyone's throat and then shooting it off to the next guys. So
I think things will settle down. And I think that at the end of the day, Axel, I think that again, my crystal ball is broken, but if I were to pull it out and predict, where I think things are going to go, I think you're going to see just probably not a drastic price drop, but what you are going to see is a lot less transactions in multifamily. Those that don't need to sell, like I got deals. I mean, I'm not pounding my chest at all, brother, but I got deals that are at like, I got 3.2% interest on a couple of my properties on like agency fixed long term, right? Why am I selling that anytime soon? I'd be smoking crack if I sold that property, because I can't. I gotta go. Then I'm gonna go like sell that so I can borrow the same dollar for like 6.5% today, right?
Literally twice the rate.
Right.
Literally twice.
I'd be out of my mind. I don't care how much money you make, because what do you do with the money that you make, that your investors make too, by the way? They're going to make a lot of money, and they're going to want to go somewhere else, but just the dollar doesn't go as far. So if I've got deals that are healthy and performing, which, a lot of folks that have been around for a minute or two do, that are on fixed rate debt, why would I ever sell? In a market where cap rates are going to be rising, where I'm going to be getting pressure from the market to reduce my price and everything like that, right? So, but I think what we are going to see is you're going to see some stuff trade, but it's going to be either people that have to, people that are getting out of the business, that are aging out. We haven't really talked about the baby boomer generation that owns a ton of multifamily that are still aging out of this business, that don't want to do this anymore. I think that's like the real silver tsunami is the owners that have been in this business for 30, 40 years. And I've transacted with a few of them, but there's gonna be a ton more, right?
Oh yeah.
You're gonna have the bridge debt owner that was on bridge that, like you said, dropped in a ton of pref equity behind it and 5% common or whatever. That seller may have to come into Jesus meeting with their equity, or may end up giving the keys back to the back from the property back to the bank. And I don't wish ill will on anybody. But those deals there may be more of those, but I don't see that causing a absolute bottom falling out in multifamily like it happened in 2008. I was around for 2008. I saw it happen. I don't see the same trade winds happening now that happened then. It's not, history does repeat itself, but not maybe a lot of times it's not in the exact same form and fashion,
Yeah, no, 100%. And those are certainly great comments. And, yeah, it's just what's happening is just different, right? I mean, it's, we can still see some kind of pullback, and it's just each crash or each adjustment in the marketplace while the end result is that prices drop and there are slightly more deals, maybe there's less money in the marketplace, which people tend to forget to talk about, is like, yeah, there's more deals, but it's also harder to raise the money and find the debt, comparatively to when there's, fewer deals and a ton of capital is chasing real estate. But, the causes are different, as you mentioned, right? I want to make sure that I do get to this question, though.
Please.
So, you put together a handful of deals with the friends and family JV structure. And then you mentioned you syndicated that deal in New Jersey, $1 million plus raise. Maybe it was around that time or maybe it was after that. But when did you start thinking about raising capital as like a core focus in your business, in terms of like, we are a business that raises money to go buy real estate, and I'm going to, take action in such a way that makes raising money a more of a predictable part of my business, if that makes sense?
Well, I had to just turn myself in, Axel, but like, I just realized that's what I was good at. Right.
Yeah.
And I'm good at getting attention from my company, shooting the YouTube video, writing the article for Bigger Pockets, going on awesome shows like your podcast here, and, preaching about my brand, or talking about the real estate business, or talking about these kinds of things, speaking at public events, and being the magnet for eyeballs for our company. Everything else I did in such a mediocre fashion. I was a terrible landlord when it came down to being the direct point of contact for tenants, right? Because I'm too nice. When they told me they couldn't pay their rent that month, I would believe them, and I would give them time off. I was really bad at managing contractors. I loved every market, I wouldn't just pick one market and stick to it. Every market made sense and was amazing. And so when I brought in partners that could focus on the things that I was not great at, was when we really started to flourish, and I really was able to focus my energy on just raising capital. And so now I've got just a handful of partners that do the stuff that I'm not good at, like the asset management, the market analysis, the underwriting. Because even though I got a background in engineering, Axel, believe it or not, I'm actually not that good with Excel. It's like shocker, but and I'm good at math and science. I just don't have the attention span for it. So there are people around me that are great at those things, and I actually am so passionate about this concept because I have so many people come up to me that are like, hey man, listen, I want to get into real estate and I get into multifamily or scale into commercial, but I just don't like talking about money with people. It gives me the heebie-jeebies and whatever. And like, that's cool. You don't have to do that. There are other things you can do. And so because of that, we developed, believe it or not, a personality assessment for people to take to figure out which multifamily activity they should be doing. Because not everybody should be out raising money. There's people out there that's just not their shtick. But I'll bet you that they either should be underwriting, they should be finding markets, or they should be driving the business plan once it's built.
100%. Yeah. And I think you just got to find your lane, right? And the fact that you were early in this world of, call it creating a personal brand or just creating awareness, right? That's what everybody calls it now. Is you creating your personal brand and attracting
becoming a thought leader.
Yeah, exactly.
Sometimes we're going to hear that, right?
Yeah, it feels saying that makes the imposter syndrome kick in quick. Where talking about doing that because it's like it sounds
like you're brainwashing people as a thought leader. It's like I'm not telling people how to think. I want people to think on their own, man. I don't want to be like, I don't want to lead their thoughts. How about I just offer my idea? How about idea sharing? Can we call it that?
Yeah, exactly. It's really just, you're just out there sharing your story and sharing some value, right? It's like, here's a story about me and our business, and here's some stuff that you might find valuable as someone that's also in this game. And eventually people just start coming to you, I would imagine.
Yeah. Right. Yeah.
Now, let's say, let's put ourselves maybe back in your shoes, back in, back in the early days as you were starting down this road, or hypothetically, the listener that's out there that is maybe, brought in the uncle and the two college buddies for 50 grand a piece, but they're like, I want to blow this up. I want to raise more money, right? Outside of maybe getting active online, maybe sharing some content on YouTube, on social media, and maybe mention it to folks in their network. What are a handful of tips maybe for them to get to that first million raise, that first $1.5 million raise, starting to really grow their base?
Well, okay. So the first thing you got to do if you want to continue to raise more and more capital is to just document your track record on deals that you've done. I am a big start small and scale up quickly type of mindset person. So if you're going to start small, find a couple people that love and trust you because you're you, like your mama, your cousins, your uncles, your next door neighbor, whatever, the people you go to church with, your kids, your kids' buddies, parents, whatever you got. And do a couple of small deals with them, and then document the heck out of those small deals, right? Document the track record, document what you're learning, document your mistakes, document your wins, right? And then take that documentation track record of it and start to broadcast it in some means that makes sense to you. We do a newsletter. I put it on YouTube, put it on a blog, whatever it is, to get it out to the world. Put it on Facebook, right? Just don't be like a braggart on Facebook, right? But like put up education, like, hey man, look, check out this kitchen. I just renovated this kitchen, and check out these cool cabinets. I got them on sale. They're really cool. Thanks for watching. Hope you have a great day. Right? That's it. Put up like not like, hardcore sales. There's too much hardcore sales on Facebook. Yeah. Put up real education stuff on what you're learning from deals that you're doing on social, right? And then that's what we did. And before you know it, what you're really doing is when you do those things and you put it out in your social feeds. And I'm a big social media. I like to use social media to market, because you can either put up pictures of your kids or put up who you think ought to won the election on social media, or you can put up things that really make you money. And the first two don't really matter. Although put up a picture of your kids, that's cute. Nobody cares who you think wins the election. Nobody cares. You're not going to change anybody's mind. So keep your political opinions to yourself on social media and put up things that'll make you money, right? How about that? And so put up real estate education stuff. So we do that. And what you're really doing when you do those things, Axel, is you're raising your hand to your community of people that follow you and go, hey, I'm investing in real estate. I'm investing in real estate. I'm investing in real estate. It's like a subliminal message, that they see when they scroll the social feed. And before you know it, they're like, hey, when you see you at a cocktail party, they see you at an event or a barbecue, or they even email you and say, hey, you invest in real estate, don't you? Like, I do. How did you know? Because that's kind of how it goes up. So it's like these little small drips, and it's not going to happen in a day. It's not going to happen in a week or even in a month, but in like 6 months, if you do fairly religious social media posts in whatever form or fashion that makes sense, in educational format only, non-pitch, people will start to ring your phone. And that's what happened for us. And we also started, I'm a pretty good writer, so I decided to start writing for blog sites. I stumbled into Bigger Pockets when they were just getting going. So you could try Bigger Pockets as well if you want to get going now, although that space is a lot more crowded. I got lucky and got in when they were getting going in that. So find another maybe blog site that'll allow you to write for them, and they're starving for authors, starving for people to write content. Start doing that there too, right? So Absolutely. Those are just some off the cuff ideas, Axel. How did I do?
No, that was great. I think that's the playbook, right?
Yeah.
And I say stuff that's pretty similar, or share tips that are really similar, where it's like, you're not, you don't even need to be so much as just educating, where it's just like, this is just what we're doing. Like, look at it. This is the building that we bought. This is, as you mentioned, right? This is the kitchen that we're renovating. If you want to sprinkle a tip in here or there, that's great. But at the end of the day, people just want to know that you're in the trenches, that you're in the game, that you're in the weeds, that you're out there, that you know what you're doing. And by doing that, you passively build trust and credibility, which is ultimately the biggest domino that you got to knock down, or the biggest barrier you got to get past with folks.
I'll tell you this. What you and I do for a profession, real estate investing, is so intriguing to the rest of the world. We've all been at a cocktail party, and people say, what do you do? Oh, I'm a school teacher, firefighter, or a CPA, or a lawyer, whatever. What do you do? Oh, I invest in real estate. They're not going to change the subject. That is an interesting profession that you don't hear very often, right?
100%.
Like, really? You invest in real estate? Like the people on TV on Flip That House? Yes, that's what I do. Just like that, right?
Exactly.
Yeah.
And I make the same amount of money, and it all goes perfect. Yeah.
And everything goes perfect. And I make 80 grand in 30 minutes like they do just on that show. Right?
Yes, exactly.
Yeah. No, but like people don't change the subject because what we do is interesting. And so you got to realize it is intriguing. And so, yes, what you're doing to that kitchen to paint the cabinets or to change the countertops out, or what you do to get the cigarette smell out of the apartment that the tenant lived in for 5 years or whatever it is, like, it's intriguing. People don't live as interesting lives as real estate investors do. So they enjoy the story. So you're going to get interest by just putting this kind of stuff on social, not salesy stuff, just education. Hey man, this is my day. What do you guys think?
100%.
Yeah.
I mean, it's just, it's just fishing with a net and just letting the net hang out in the water versus going out there trying to spearfish, right? I mean, one is, you might get more fish faster if you're out there throwing spears at them, but at the end of the day, it's a much trickier way to at least get off the ground there. But just letting people come to you, I think it's a much more predictable way to build a business, and you're doing so in a lower stress environment, right?
Nobody wants to have a spear thrown at them. And people know what a pitch looks like. This, and you know what it is? Nobody wants to have spears thrown at them, and there's a lot of people throwing spears these days. To use your analogy,
100%,
right?
100%.
There's so much like noise and pitch, and like, hey, come run to the back of the room. I only got 3 left, or whatever. It's so refreshing to see somebody on social that really just wants to teach you, and it creates a lot of trust and affinity very quickly. And so that's why you want to do it, because people see through it. People see you're authentic. If you can't tell already, I'm an enormous fan of Gary Vaynerchuk. And so if you want to learn where a lot of my mindset goes when it comes to how the proper way to post on social and how to build a social following, a lot of it's from him.
Yeah, document, don't create. I think that's the big takeaway here that I think he coined, right? That's really helpful to just always have in the back of your mind. Yeah. A bit of a gear shift here. I might be just sending the car off the highway a little bit abruptly.
Oh, that's great. I'll bring it back.
But something that it seems that you're passionate about and that you like to speak about is incentive-based landlording. That's a concept that I want you to dive into because that terminology is a little new to me. But why don't you talk about incentive-based landlording? And I don't even have a question. Just want you to kind of dish on that and maybe talk about what that means and why that's important to you.
Yeah. I've done all kinds of cool stuff. Years ago, when I used to manage about 115 units myself, like out of Trenton, New Jersey, which is where my wife and I got started. We had a small staff that worked for us there. We've since scaled out. We don't self-manage anymore. But when we did, a example of incentive-based landlording was when tenants would pay their rent, we would literally put their name into a raffle. And at the end of the month, each month, we would pull one name out and give them a gift card, right? For paying their rent on time. And then once a year, we would pull a name out of the hat and give a flat screen TV away. So this is back in the day when a flat screen TV didn't cost the same as a hamburger does. Now
I was just going to say, back when they were $200. Yeah.
Right. I know. Yeah. Like maybe 200, right? I mean, but that's for the big one. It was 200, right? Yeah. It's 200 now. But back in the day, that was like $400 or $500 investment that we would do. But if you think about the win-win that we're creating by having this community, people that are really excited to pay their rent on time. Think about that, like guys would call, tenants would call and say, hey, just want to make sure that our rent made it on time because I want my name to go in that raffle. It's crazy, like we did tenant newsletters and everything like that. And so it made me think about a factor, Axel, called tenant happiness. And that is something that we gauge, something that we measure at DeRosa Group. It goes back to the mantra of my company, not to get too gushy on you here, but transforming lives through real estate. That's why we do what we do, is to make things better for people. And I believe in seeing the human side of landlording, that we are dealing with, actually, believe it or not, another human being on the other side of that transaction. To talk too much about doors and to talk about units and to talk about pushing rents and to talk about rent bumps and that kind of stuff without thinking about the human that's affected on the other side of that transaction is really making this thing too transactional, right? There is a life there that's being affected by the work that you do in your business. And so, we do like non-incentive based stuff. Like we try and when a crime happens at our property, I take it very, very seriously because I don't want my tenants to live in an environment that they have to deal with living in a place where there's crime happening. Right. So we try and decrime our properties as best we can, as fast as we can. And we have all kinds of technology that we use to do that. So our properties are very, very low crime. Things happen sometimes, but for the most part, we have very few, if any, crime at all at our properties because the technology we use to keep it low. That is an incentive in some ways too, because I give tenants a great living environment. Now, from a business perspective, Axel, on the other side of all the gushy stuff about us wanting to do right by people, and we do, there's also the more pragmatic side of it, is if you create an environment that people feel valued by their landlord, by their owner, and they see the owner doing stuff. Like now we're at a level where we own bigger apartment buildings and we do everything from bringing in jumpy houses to hot dogs to we had Of all things, we had a nacho party. Like that was an absolute mess, but we did it. We had a nacho party at one of our apartment buildings a couple months ago. Well, I don't know if I'll ever do that again because it was a total mess. It's like nacho cheese gets everywhere, doesn't it? So but we had like that. The tenants loved it. It was great. A few of our properties have pools, so we'll go out there with barbecue every here and again and have a pool party for the tenants and everything like that. That's incentive-based landlording as well. We give them a little something, and what it does is it makes them not want to move. It makes it makes the property sticky. It makes them want to stay there because. To go back to dollars and cents, and that's okay. This is we're not, this isn't a hobby. We do want to make money, right? From a dollars and cents perspective, the biggest expense you will have on any property, forgetting about utility bills, forgetting about insurance increases, real estate taxes, vacancy is what will cost you. But people don't think enough about that. If I can prevent that tenant from moving, right? And keep them happy and make them stay in there, get them to happily stay in the property for 2 or 3 years longer. Why wouldn't I do that? And to get them to stay and to, grow their family and extend their residency with me. So I don't have to deal with that vacancy, because the vacancy will maybe suck out the cash flow I would have made off that unit for the entire year.
100%. Yeah. And first of all, I could nerd out on this topic for a while because we own our management company and I like to get in the weeds with the nitty gritty of the operations and all of that. But and first of all, I should say that the mission of transforming lives through real estate is such a great mission because that is so lost in what we do, fundamentally speaking, right? Especially for folks that are not in a position to where they're on the front lines, right? For the folks that are raising the money and the property's in another market, and maybe they get down, maybe they walked it during due diligence, maybe they get down there once a year and they're just so removed from what's truly happening. It's easy to forget that, right? And we invest locally and we own our management company. We see that very regularly, and it's reminding, right, that there's other implications.
There's actually a live human being on the other side of that check that they're sending you. Like that check was actually written out, or that button to push to pay the rent electronically was pushed by a human being.
Exactly.
That's living in the residence that you're providing them.
Yeah. And then to close it up, because this is a topic that I'm becoming increasingly aware, or just a part of our business that I'm becoming so aware of now as operations becomes more and more important, as the market's not bailing us out like it did the last few years in terms of, maybe you didn't run it as well as you could have. But the difference between a property that like regularly maintains, 85% occupancy and one that maintains 97, 98 is a world of difference, because your expenses are the same in real estate, regardless of the occupancy, outside of maybe a couple line items like your water sewer bill if you pay for water and maybe your repairs and maintenance. But insurance is the same, your taxes is the same, your common area electric is probably the same, your contract services are the same. All of that stuff is the same. Your legal is, about the same, maybe a little bit more if you have a higher occupancy, but that's why occupancy is so critical. So you have to create a strategy that maintains that, because that's where all of your NOI comes from.
And I'll give you another statistic, right? If you look at a multifamily that's not doing well, all you got to do, here's the factor: read the reviews. These are larger properties, right? Read the Google reviews, and the tenants at the property will tell you why they're moving out, why they're not happy. And 9 times out of 10, it is, and I didn't get to mention this in my rant about tenant happiness, right? It is because the owner doesn't take care of things. It's because this owner doesn't fix anything that, whatever. Now, obviously, tenants that are upset or getting evicted or whatever are going to write a bad review because that's like their only voice they got. But when folks are complaining legitimately about stuff, it is because of things like lack of pest control. It is because of lack of work order response. It is because of lack of capital improvement maintenance. So, the roof is leaking, the windows leak, the HVAC doesn't work, those kinds of things. And so if you really want to go into data and measure things on how to keep your tenants happy, look at the number of work orders your property has open at any given time, and look at the amount of time that work order stays open from the time the tenant turned in the work order to the time the work was addressed. You might be embarrassed at how long some of these work orders are out there. I mean, it might be like 3 to 4 weeks. You do better than that, right? Yeah. At the end of the day, I wouldn't want to wait 3 to 4 weeks to have work done on my home. I wouldn't tolerate that. Neither would you, and your tenant shouldn't either. And so, and if they have to tolerate it for long enough, they will move,
100%.
And so that's the way you keep them happy, is by addressing their concerns, and the concerns, what do they want? They want safety, and they want stuff to get fixed when they complain about it, as long as it's reasonable,
100%. No, and that's a great closing comment here because, now I can say we talked a little bit about operations and raising money, right? And that's always good because I think the raising money stuff is the sexy part of the business. The finding deals is the sexy part of the business. But I mean, now it's more true than, at least in terms of my time in the business, it's never been more true in the last 7 or 8 years, how critical it is to really effectively operate your properties, right? And to manage well, to do right by your residents, to provide them a great service so that they don't leave and so that they say great things about your community or your company to their friends, their family. And, there's a compounding effect to doing a good job there. And, again, that's a whole nother episode, but I'm glad that we touched on that.
We'll just have to do it again. Because there's so many more rabbit holes. I didn't realize you owned your that you manage yourself. There's a lot. There's a lot of you and I could share some war stories as managing, because I managed myself for about 10 years before we started buying out of the area that we're in geographically. It just didn't make logistical sense. And sometimes I think about getting back into the management game because I just think that it's such a critical piece of the equation. So we'll just have to have another episode.
100%. I would love it. But until we do that, why don't you share where folks can get in touch with you, where they can learn more about what you got going on and potentially reach out to you?
No problem. So if you guys want to take the assessment I talked about, which is a free assessment you can take, that'll tell you which real estate superpower, you guys can, watching me live, you can see I'm a superhero guy, right? So which superpower you are, you can learn all that and among many other things at DeRosaGroup.com, our website, DEROSA Group.com. You can, learn from us, you can invest with us, and you can just join our communities at that website, DeRosaGroup.com.
Awesome. Sounds good. Well, this was great, Matt. Appreciate the time.
Thanks, Axel.
Thank you for listening to this episode on the Multifamily Wealth Podcast. If you learned something new during the show, please consider sharing this episode with a friend, family member, or business partner, or just leaving a rating and review, as it helps the show get noticed by more folks. Catch you next week.